Hi, you're watching Investor Insights, and in this video I'd like to discuss the most important aspect of stock investments aside from capital preservation. And this consideration is the price earnings ratio. It's a very simple aspect of stock analysis, but if it's done correctly, it is the most important factor that makes you decide whether or not you're going to invest into this company. Now, the price earnings ratio is simply the price of the company that you're willing to pay divided by its earnings. And it's very often loosely taken by people as how cheap the company may seem or how expensive the company may seem. Now, it's a free market, so every investor can make his or her own decision based on whatever factor that they decide, whatever methodology they have in stock picking. But if you're just beginning, or you could be the most professional investor out there, in that case you don't need to be watching these videos. The PE ratio has to be the most foremost and important number that you have to think about before you make any of these investment decisions. So you have to treat this PE ratio almost like buying the entire business yourself. You just have to have the mentality that, okay, you've got all the money in the world and you are going to buy this company outright. So if a company is worth $5 billion, and in that year it makes $500 million. So the price of the company, the price of all its outstanding shares is worth $5 billion, and for that you're going to earn $500 million. So the price earnings is 10. A lot of textbooks will tell you that 10 is a low to average PE number. You can buy when a PE is below 10. You should sell when it's above 20. If everything was so black and white, nobody would lose money. And this is also very reliant on companies giving correct information and people interpreting that information in conjunction with the investing environment, the economic climate, and the sector in which the company is in relation to every other company that's out there. Every other sector that's out there, and the prospects for growth. Not just the company you're buying, but every other competitor within that sector. Right? We're just talking PE today. So if you were to buy a company worth $5 billion and it made you $500 million a year, it means that you would basically get all your money back within 10 years with all factors remaining the same. Obviously that's not going to happen, but it's a very simplistic view of it. That's a pretty good deal. Sometimes the number can be much lower than that, in which case it was a bargain, or sometimes it's much higher and, well, it's just too expensive. Years ago, Packer bought the Crown Entertainment Complex in Melbourne for $600 million. within its first year of operations under his leadership, it made him $300 million. So he bought that investment on a price earnings of 2 to 1. That's cheap as. Okay. If you look at the other extreme, say Netflix, it's one of my personal favorites to bag, not to compliment. It has a price earnings of over 300. That means that if you were to spend the $14.5 billion that all the outstanding shares are worth as of yesterday, you would only be making about $18 million a year. Quite frankly, if you had $14.5 billion and you were to put it in something and it would only give you 18 million in return, mate, don't bother. And if that's the real life situation, why would you do it in a stock? Sure, it can keep on going up because all these lemmings are piling into it, but you just don't want to be part of this crowd when it gets squashed. And when you buy something at a P of 300, odds are you're going to get squashed. PEs are either backward looking or forward looking, and therein lies some deception from the companies if they give you incorrect guidance, or they themselves don't know what they're talking about and their guidance are just rubbish. The trailing PE ratio is its past earnings and its price divided by its most recent earnings. That gives you a more correct gauge, a more realistic gauge of what the true PE ratio is. Because if you look at now the forward PE ratio, that is the price divided by the expected earnings, you're playing a dangerous game. And in this bubble environment that you're living in right now, in 2013, if you were to watch any financial channel or commentator or read any article by anybody who's part of the investment community, will tell you, oh, the S&P is trading at a reasonable value. It's only trading at 15 times forward earnings. And whenever I hear the word forward earnings, they're expecting perfection out of either the economy or the sector or the stock. And if you're paying for perfection and it doesn't come, you're going to get crushed. I cannot stress this thing enough, that you should not be making all your investment decisions or taking the forward PE ratio as the most important consideration before you make a stock picking decision, because you're opening up Pandora's box. You can have companies that give deliberate false guidance, a la Enron or WorldCom, or you just have an economy that's really weak and unstable so that its growth is not sustainable, and that the guidance is given by these CFOs that got their degrees from Disney World. So, in conclusion, when you look at PE, treat it as if you're buying the company outright and look at the returns. Preferably looking at its most recent returns, as in its last financial year's earnings or the previous couple of years, rather than looking at the forward guidance that the companies give out, or even worse, that the analysts are giving out. I wouldn't trust them as far as I can throw them. Until next time, happy trading.